Okay, as I mentioned before, millions of Americans, they've seen their credit scores fall in the last year. One reason is banks are cutting people's credit limits. But is that a fair reason to have your FICO score lowered? Well, here to talk about that and more, we're joined by FICO CEO Mark Greene. And Mr. Greene, great to have you with us. Thanks so much.
Good morning. Great to be with you. Okay,
so before we get into the nitty-gritty, though, I just want to get sort of the big picture first. I mean, what is going on today during this crisis with credit scores? Are they taking a tumble, holding up, or are they actually getting better?
It's a very interesting question. Actually, a tale of two cities, if you will. People who've had low FICO scores, who've had trouble paying off their bills, are finding that their scores are trending downwards, not by a lot, maybe 10 or 20 points out of the 850 total. But what might surprise you is at the other end, people with good credit scores are actually seeing them going up as they're doing an ever better job of managing their financing. So we're seeing sort of a flattening out of the distribution curve, more people at the bottom and at the top.
And the fact that you may be seeing more people save, is that helping credit scores?
Absolutely. Saving is good so long as it allows them to pay off their indebtedness. The main thing that drives FICO scores is, are you current with paying off your bills? And if you're doing enough saving to sort of help your balance sheet, but also paying off your bills at the same time, that's a good thing.
Okay, I want to get now, Mr. Greene, of course, to those issues that I just talked about where banks are cutting the credit limits for various customers, and that in turn is lowering their credit scores. And I believe that this affects about 33 million Americans right now with credit scores. Some of that, I believe, a quarter is because it is justified. They've had some risk triggers, and that would certainly mean that their credit limits would be cut. But others are saying, no, that's not fair. Why should that happen to us?
So let's first of all understand what banks are doing. Banks have a need to fix their balance sheets. If they've extended a large line of credit to you and you're not using it, they still have to reserve against the possibility you might use all of it, and that sort of requires a lot of regulatory capital. So banks are interested in shrinking credit lines, or what's called credit line decrease, and we're actually impressed that they're doing that very sensibly. They're using sort of scalpels to do it client by client rather than sort of a hatchet approach. What it means for the consumer depends on the consumer situation. If you're not already close to the margin on your credit line, your score actually won't change if they retract your line. If you're already close to the edge and they pull it in, your score may go down by 10 or 20 points, and that's probably appropriate. It reflects in the heightened level of riskiness on the part of the bank as they view the consumer.
But what if somebody, for instance, had a $10,000 credit limit, they carried about a $5,000 balance, which is okay, and then they get their credit limit flash to 5,000. Suddenly they look as if they've maxed out their credit card, and that's going to bring their score down. Does that then require some responsibility on your company then to fix the formula by which you rate these consumers?
Formula works just fine, and by the way, I want to point out it's sort of very objective-based formula based on historical evidence. There is a lot of evidence that if people are close to their max, whether they got there themselves or the bank shrank their line, that they become somewhat riskier going forward. And again, we're talking the order of 10 or 20%. FICO scores get sensitive to that, what we call credit line utilization, when you get around 70 or 80% utilization of your line. So for many, many people, this is really not an issue. For some people, it is an issue, and they're working with the banks. The banks have a lot of motivation to get this right with the consumers.
Yeah.
We encourage consumers to contact their credit card company, contact their mortgage company if this is an issue for them. But let's explain why this is important. As you've said previously on the show, this is really a consumer-led recession, and we really need healthy consumers to get us out of this recession. And there are still worry signs out there. The mortgage problem that banks are facing is yet to crest. Right behind it comes this next wave of credit card problems. Many banks facing 10% charge-off rates still in their credit card portfolio. So it's in everybody's interest to ensure that there are healthy consumers going forward, and we're not quite there yet. We clearly have a couple of months, maybe quarters to go.
Okay, Mr. Greene, we're out of time, but thank you very much for joining us on this very important issue. It affects, of course, every American who borrows.